I want to talk to you about rental property tax deduction audit triggers, what the IRS is checking on Schedule E. Don't go anywhere. Welcome back, folks, to another edition of the Awesome Studio Kiwi Show. How are you today? I hope you are doing fantastic. I'm doing marvelous, if you were to ask me. If you are doing as great as I am, go grab a cup of coffee or tea or vodka and let's roll. In today's conversation, I want to talk to you about rental property tax deduction audit triggers, what the IRS is checking for real on Schedule E. Number one, filing the correct form. The IRS will check whether you qualify to file Schedule E. Now, this form is specific to certain business activities, and using it without justification may show what? Recklessness from your business, and this could trigger an audit from the IRS. Remember that Schedule E specifically relates to what? Income or loss from rental, real estate, and royalties. So if you are in the business of renting personal property, you want to use Schedule C, not Schedule E. And if you are an individual, you want to report farm rental income or loss from income or loss on Form 4835. All right, and this is this kind of information you have to report it on page 2, line 40 of Schedule E. All right, so I'm showing you right now on the screen Form 4835 that applies again specifically to farm rental income or loss. You can see here on part 1. You have to show gross farm rental income based on production. So you put all the relevant information there. And on part 2, on the screen right now, you can see it. You have everything. You have to put all the expenses from the farm rental property. And so everything from car and truck expenses to chemicals to conservation expenses to employee benefits to feed, fertilizers, and lime. All this kind of stuff has to be on Form 4835. So the first thing you need to do if you want to avoid an audit from the IRS as relates to your rental property tax deductions, you want to file the correct form. You want to be sure that you qualify to file Schedule E. Very, very important. Number 2, the second audit triggers. You have 1099 filing requirements. And this, you see it on Part 1, Section A. So if you look at your Schedule E, Part 1, Section A, it talks about there is a question that says, did you make any payments in 2020 that would require you to file Forms 1099? It is very important to be careful there, because you have the IRS will check whether individual taxpayers indicated on your tax returns income received from your organization. In other words, the government will then reconcile that total income reported to the IRS via all 1099s with the total compensation amount you report on your Schedule E. So keep in mind there are now 2 forms 1099. So we have 1099 NEC, the NEC, non-employee compensation, and 1099 MIS. So if you hire vendors, independent contractors, freelancers, or gig workers and pay them more than $600 in business-related payments, then you will need to prepare and issue an IRS Form 1099 NEC so they can file for an income tax return. While this may seem like a complicated procedure to issue these 1099s, it can be pretty straightforward with the right tools and processes in place. All right, so the 1099 NEC goes to freelancers, independent contractors, or gig workers, whereas 1099 MIS, because that form is still around, it goes to lawyers, it goes to companies, but lawyers, really. And one thing that's very important you have to understand is that the due date for the 1099 NEC is January 31st in the year following the applicable tax year. And another thing I want to say here is that there are a few exceptions to these rules. You don't have to send 1099s to most corporations. Note, you must send 1099s to all lawyers you've hired, even if they are incorporated. You have to send the same forms to property managers for rent, sellers of merchandise, etc. The 1099 miss form should not be confused with the 1099-K, right? Which is required to report third-party networks or vendors that process payments. This is something totally different. So this is very important. And one last thing I want to say is that this applies only to independent contractors. So those are temporary workers who provide goods or services to your company under specified terms outlined in the contract. Number 3, we have fair rental versus personal use days. And this is on part 1, section B2 of Schedule E rather. And it's very important that, and first of all, let's just define what the IRS considers personal use. It means used by the owner, used by the owner's other family members, whether they pay fair market rent or not, used by anyone else who pays less than market rent, use of the property by another party under a reciprocal sharing agreement, whether the other party pays market rent or not. And the days devoted principally to repairs and maintenance are considered days of vacancy and are disregarded, even if family members are present while you work away. And you have to have substantial personal use with minimal rental. This is when the IRS thinks about this as personal use. And you also have substantial personal use with more than 14 rental days. And this category includes a vacation property, for example, rented for more than 14 days during the year with personal use that exceeds the greater of 14 days or 10% of the 10% of the rental days. What I'm trying to say here is that it's very important to understand if you want to claim expenses related to that property, the property must be used for business. You know, this concept harks back to the concept of hobby versus business. And the IRS wants to make sure that this is a rental property. This is a property that is geared toward generating income, not your personal use, right? So this is very important. One thing I want to say is that the IRS considers a vacation home to be a rental property when it is rented out for more than 14 days during the year, and personal use does not exceed the greater of 14 days or 10% of the days it is rented out at fair market rate. Very important. We have the concept here of fair market rate, not something below market rate. No, the transaction must be at arm's length. Okay. Once again, mortgage interest, property taxes, and other expenses must be allocated between rental and personal use based on actual days of rental and personal occupancy. However, mortgage interest allocable to personal use will no longer be deductible on Schedule A, and a rental property does not meet the definition of qualified residence interest for itemized deduction purposes. And one thing I want to say to close this section is that taxpayers can potentially deduct the personal use portion of real estate taxes on Schedule A, subject to the limitation on itemized deductions for state and local taxes. Item number 4 here, folks, we have auto and travel. And this is on part 1, line 6 of Schedule E rather. You can see on the screen here, we have the auto and travel line 6. And so if you are a landlord that travels to multiple properties or your rental is located far from your residence, your transportation expenses are fully deductible. And this includes paying to show your rental property, collecting rental income, and conserving your rental property throughout the year. Excluded from this policy, however, are any reasonable commutes made regularly. And you can actually deduct travel using 2 methods: actual expenses or the standard mileage rate. All right. And for 2020, the standard mileage rate for business use was 57.5 cents per mile. And remember that travel, very important here, travel must be for rental activities. So you can deduct the cost of driving to your rental property, where you have your principal place of business for your rental activity, including a home office, places where you meet with tenants, suppliers, vendors, repair people, attorneys, accountants, real estate brokers, real estate managers, and other people who help in your rental activity, the bank where you do banking for your real estate activity, the garbage dump where you haul refuse from your rental property, a local college where you take landlord related classes, for example, educational expenses, are basically deductible only if your rental activities qualify as a business, or a store where you buy supplies or materials for your real estate activity. And and landlords who have a home office have specific rules. Again, we have the home office deduction rules, and landlords who don't have a home office can actually deduct rent. And yeah, one thing I want to say here is that it's very important to remember that you need to keep all the documentation. You got to have all the paperwork. Keep the receipts to prove to the IRS that you are actually, running this as a business, and that all transportation, all car expenses are actually deductible. And this is a great audit area for the IRS, and the agency has an algorithm called DFI, and they actually look at things like home office deduction, car expenses, and that kind of stuff. So this is very, very important. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another session of the Awesome Sweetie Kiwi Show. I'm still talking to you about the rental property tax deduction audit triggers. And number 5, I want to talk to you about insurance premiums. And this is on part 1, line 9. You can see on the screen here right now. I'm showing you right now. Line 9, it says insurance. Do you see that? All right. Lenders can, when we talk about insurance, there are a couple of things. First, lenders can stipulate that homeowners get an insurance policy before securing their mortgage, right? Luckily, any form of insurance is considered an ordinary and necessary rental property expense, and this is thus deductible. And the deduction applies to basic homeowners insurance as well as special peril and liability insurance. So from a landlord perspective, any insurance premiums that you have to pay, you can deduct that. If you have employees, you can deduct the cost of their health and workers' compensation insurance too. Fantastic. Although insurance premiums tend to be a bit higher for rentals, this boost can help offset that, right? So landlords can also deduct losses, including those caused by hurricanes, earthquakes, flood, and theft. And however, and this is a big however, folks, it's a big however, do not prorate your annual insurance. I'm talking here about homeowners, hazard, flood, etc. Don't prorate your annual insurance. You will only report the amount of insurance that you actually pay to your insurance company, not the amount that you pay into escrow. Including escrow amount in here could trigger an audit. And let me quickly talk to you about escrow. It's very common to pay insurance and property taxes into escrow on a monthly basis. And this basically protects the lender from your failure to pay those expenses. It's important, however, to understand that when you pay these expenses into the lender's escrow account, guess what? This is not a deductible expense for you. It's not. It's only deductible once the lender actually pays those expenses to the county, city, or the insurance agent. That's when you can deduct the expenses. Why? Paying into escrow is essentially moving money from pocket A to pocket B. Because if you really think about it, it's still your money and technically an asset on your balance sheet. It's actually called prepaid insurance. That's how it's called in accounting. So, you put this as a short-term asset or long-term asset, depending upon the maturity of the asset. But it's called prepaid asset. So it is an asset. It's not an expense. Item number 6, we have here repairs. Now, repairs, again, if you look at Schedule E, it's on Part 1, line 14. It's very important. The conversation here has to revolve around repairs versus capital improvements. And there is a threshold there is a threshold under which you have to be to qualify an expense as expense, and above which you have to qualify an expense as a capital improvement. And so the IRS sets specific standards for an improvement to qualify as a cost basis increase, aka expense. So repairs or maintenance cannot be included in a property's cost basis. However, repairs that are part of a larger project, such as replacing all of a home's windows, do qualify as capital improvements. And so the thing here is that capital improvements really are durable upgrades, adaptations, or enhancement of a property that increase its value, often involving a structural change or restoration. And the IRS grants special tax treatment to qualified capital improvements, distinguishing them from ordinary repairs. So in addition to enhancing a home, capital improvements can increase the cost basis of a property, which in turn reduces the tax burden when it is sold. And the thing here you have to understand is that to consider capital improvements, you have to think about things like cost basis, right? That's the cost, that's the original cost of the asset, of the house, of the property, and capital gains. So in addition to improving the home, a capital improvements per the IRS increases the cost basis of a structure. That is, expenses incurred upon making the improvements are added to the amount the owner paid to buy or build the property. So and then you also have the local exemptions. So there are in some areas in the country, you have some exemptions. For example, New York State's rent laws include a provision called the Major Capital Improvements, the MCI program. So dating from the 1970s, this MCI program allows landlords to raise rent stabilized or controlled building rents by up to 6% annually to recoup the cost of major capital improvements to those structures. And so this is very important. So everything from new elevators, updated common spaces, or other improvements all count toward the MCI. I want to talk to you now about number 7, depreciation expense or depletion. Here we are talking about part 1, line 18. Remember though, depreciation is an imperative part of IRS Schedule 8. So do not mess it up, folks. Property depreciation is an important tool for rental property owners. It allows you to do what? To deduct the cost from your taxes of buying and improving a property over its useful life, and thus it lowers your taxable income in the process. All right, so the rental property owners use depreciation to deduct the purchase price and improvement cost from your tax returns. Depreciation commences as soon as the property is placed in service or available to use as a rental. By convention, most United States residential rental property is depreciated at a rate of 3.63% each year for 27.5 years. That's just the standard here. And only the value of building can be depreciated. Remember, you cannot depreciate land. All right. And one thing I want to see here, and I'm showing you right now on the screen, you have to understand that there are several ways to actually depreciate. Which property is depreciable in the first place? You can depreciate a rental property if it meets all of these requirements. You own the property, you are considered to be the owner even if the property is subject to a debt. You use the property in your business or as an income producing activity. The property has a determinable useful life, meaning it's something that wears out, decays, gets used up, becomes obsolete, or loses its value from natural causes, and the property is expected to last for more than 1 year, right? And to calculate depreciation, there are several factors. We're not going to get into details here, but you have something called the MACRS and the ACRS. MACRS stands for Modified Accelerated Cost Recovery System, and ACRS is the Accelerated Cost Recovery System. If you need more info, talk to your accountant to sort of understand all this. But basically, what you need to do, you need to determine the basis of your property. You need to actually separate the cost of land and buildings. You need to determine the basis in the house and determine the adjusted basis if necessary. And it really depends upon the situation. And I'm showing you right now on the screen here, for every full year that a property is in service, you would depreciate an equal amount, which, as I said earlier, 3.636% each year, as long as you continue to depreciate the property. If the property was in service for less than 1 year, for example, you bought a house in May and began renting it in July, you would depreciate a smaller percentage that year, depending on when it was put in service. And according to the IRS Residential Rental Property GDS table, that is, I'm showing you right now on the screen, this is the depreciation schedule if you have a property if you want to depreciate a property for less than 1 year. All right, folks, last but not the least, there is an important element I want to mention here. It's called other expenses. And this is on Schedule E. You have Part 1, Line 19. This might seem a little tiny, but it is very important. You want to include there all other expenses incurred while operating the rental, but that did not directly fit into any of the categories that I just mentioned earlier. Why is this important? Why is this an audit trigger? It's because the IRS tends to pay attention to little things that don't make sense. Bottom line here is that you need to back up. You need to actually substantiate anything you are claiming here. All right. By other expenses, I'm talking about things like bank fees, education, HOA fees, subscriptions, cost of books, de minimis safe harbor if not reported in repairs, meals and entertainment, and gifts to clients or tenants. All of this must follow the law, and they must be reported. And what you do while you're filing your tax returns, you need to itemize each of your other expenses on a separate page. By itemizing, you need to not only list them, but you need to explain what they are if it's not clear enough what they are. All right, folks, this is it for today's conversation. That was a quickie, and and I was just talking to you earlier. I was just talking to you about the rental property tax deduction audit triggers, what the IRS is really looking into these days, and there are about eight of them. And number one, you want to file the correct form. If you file the wrong form, this could be an audit trigger. You have to pay attention to 1099 filing requirements, the fair rental days versus personal use days, auto and travel, insurance premiums, repairs, depreciation expense or depletion, and last but not the least, other expenses. Thank you so much for your attention. I really appreciate it. I will see you next time. But until then, remember, stay marvelous.